Good day. My name is John T. Sachs, and I'm a partner at Geltec. The topic of today's discussion is how to maximize your tax deduction. And joining me today is Craig Gradidge of Gradidge-Mahura. Craig, how are you?
How's it, John T? I'm good. Yourself, man?
Yeah, I'm very good, thank you. Craig, you introduced...
Just a little cold this side, sorry. So excuse the hoodie.
No problem. Yeah, the weather is really chilly for this time of year, but I guess we are in winter, so it makes sense.
Cool.
You introduced a really interesting concept to me a while back, and that's where a taxpayer can combine a Section 12J investment with a retirement annuity investment. And at the time, it was a very novel concept to me, and it really has taken off when I look at our investor base. You know, to be able to maximize your tax refund is always advantageous. Having attended a few of your presentations, I thought it would be really great for our viewers to experience some of your insights into not only the combination of the two tax deductions, but also potentially other tax deductible investments or solutions. So if I could ask you to please take us through the options in the market and how you advise your clients.
Great. Thanks, John T. Thanks for the opportunity. What I'm going to do is I'm going to take you through a presentation I did earlier this year when life wasn't as hectic as it is at the moment. So in talking about the 12J offerings that we were putting in front of clients for 2020, we took a step back and had a broader look at tax efficient investment options in general. So I think just to talk about tax mitigation, I think it's always important that people remember what taxes they generally pay, when it comes to investing. And the acronym we like to use is the word credits, which is ironical because this is something you seldom get from SARS. But in credit stands for capital gains tax. And there you can see the range in terms of kind of where your tax would be paid. 18% for an individual, 36% for a corporate or trust. Then retirement funds tax is the R, and that's the withdrawal and retirement tax table. Estate duty, always a consideration. So the first 3.5 million is tax-free, 20% above that, and 25% if the taxable estate is over 30 million. The D stands for dividends tax. That's a withholdings tax, and that's charged at 20% flat. And then income tax, currently 45% max. T is transfer duty, typically, that gets paid with properties, and, which I imagine some people see as an investment. And then securities transfer tax, which is really kind of a small tax that people don't even really see or pay attention to. So I think the important point that we make to clients here is that, when it comes to tax, it's not just about income tax. It's about understanding all the taxes that an investor could incur, and understanding, the fact that you could run away from one tax and run into other problems in avoiding that tax. And I'll address that a bit later. So in terms of product options, what we did is just try to create some kind of high-level scorecard as to how these various product options rank in terms of the different taxes. And what you'll see is that retirement annuities generally tend to be quite tax efficient. There's only the small issue of retirement funds tax at retirement, or potentially before retirement if investors make a withdrawal. But you don't pay any CGT on growth inside the RAs. No estate duty should you pass on, apart from any previously disallowed contributions, no donations tax, and no income tax that's paid while you invested in the retirement annuity. And there you can see pretty much all the other options. There's some kind of estate duty implication, some kind of CGT implication, and then, you know, kind of in terms of dividends tax, you know, where you'd incur the full dividends tax and no real mitigation. So I think to have that context in mind, I think it's where we took clients through an actual experience of combining tax-free saving. I mean, yeah, Section 12J, retirement annuity, and then we actually took the last bit of the tax refund and put it into a tax-free savings account. But this was a client who invested 250,000 into a Section 12J. In July, he received 102,500 back as a refund from SARS for that tax, for that investment. The client still had a bit of a gap in terms of how much they could contribute to retirement savings and qualify for deduction. So invested that into a retirement annuity. A year later, the client got 42,000 back from SARS. We took 33,000 of that and we put it into a tax-free savings account for the client. But I think what this shows is what happened on the client's balance sheet. Because on the client's balance sheet, there now reflects a 250,000 Rand investment in 12J. In fact, that value's gone up. There's a retirement annuity of 102,500 plus growth. And we've subsequently gone into the tax-free savings account. So that 250,000 Rand investment resulted in assets to the value of 394,000 on the client's balance sheet without any growth. The important thing is that, you know, we can use the tax incentives to build the balance sheet. And ultimately, you know, the last 5 years have been very tough for clients to find returns in the local market. If you can add value and build the balance sheet using tax incentives, that contributes to the client achieving their investment objectives over time. I think the one issue we also raise with clients is to understand that Section 12J, it is an alternative investment strategy. So a couple of things that we look out for alternative strategies. So it's important that clients interrogate this and that they're comfortable with alternative strategies in general. So alternative strategies are just kind of your non-traditional investment strategies like private equity, hedge funds, Section 12J, structured products. So where there's some kind of structuring or some kind of, you know, non-listed opportunity. So we think, you know, alternative strategies have a place in client portfolios. Certainly there's a diversification benefit. They can enhance return by investing in inefficient markets. There's the inflation hedge from exposure to growth assets. And they get exposure to new opportunities that perhaps they can't get on the JSE. So if we look at some of the 12J, the underlying investments in your 12J offerings, clients can't get those exposures via any kind of company on the JSE or any kind of product. I think investors need to also understand that alternative strategies have their challenges. I think transparency and particularly around the issue of valuation. So that can be a challenge. It's not always possible to, you know, price discovery is quite difficult in the unlisted space. Liquidity, you know, if life happens and you need to access your investments, you're going to struggle on the liquidity side. And generally, all those products that I mentioned tend to be a bit more expensive than the traditional investment strategies, unit trusts, endowments, share portfolios that clients are used to. So our approach as a business is that we do believe that alternative investments can add meaningful value to an investment portfolio over time. But to mitigate against the risk, we wouldn't look to allocate more than between 5 and 10% of a client portfolio. And that's just a straightforward risk mitigation step. We're acutely aware of costs, and we disclose those to clients in a very transparent manner. And then these are some of the providers that we use. So what we try and do is to stick with the bigger providers in the space, again, as another risk mitigation method or approach. So if we just look at 12J, just some of the issues that we highlight to clients is the fact that Section 12J actually refers to Section 12J of the Income Tax Act. So they can go there and find all the criteria and issues surrounding Section 12J. I think the big attraction for investors is that they can write off the full amount of their investment against taxable income in the year that they invest. SARS introduced a cap last year. It's a fairly unpopular move. And I think it's very important in selecting your 12J provider is to, ensure that they remain fully compliant with the criteria set out in 12J, so that you can keep your deductions and your protection in terms of Section 12J. I think that there is a minimum investment term of 5 years, but I think investors in their own minds need to be prepared to put these funds away for kind of 7 years at the minimum. Because while there may be this 5-year term, which is prescribed in Section 12J of the Act, there could be issues in terms of liquidity at the end of the period. So I think it's important that investors bear that the 5 years is actually a minimum. They should be able to leave it for a bit longer. And then I think the critical one is that full proceeds of the investment are subject to CGT. So if you invest $1 million and you get 800,000 back, that 800,000 is subject to capital gains tax. Because it's a tax incentivized investment, your base cost is zero, and investors need to understand that. Okay, we've been putting clients into 12J for a few years now, and what we are seeing, 12J is an incredibly young industry. There's not much by way of track record out there that investors can go and look at. So we're constantly monitoring one of our earlier clients to get his experience of 12J and see how it's playing out. So there we can see this particular client was at a 45% marginal tax rate, received 112,000 back, net investments 137, and he's earned 34,000 in dividends. So from his 250,000 Rand, there's only 103,000 that's still at risk. And for an alternative investment, we think that that's a pretty attractive kind of risk statistic to see 3 years into the investment. So there's been some growth, but the bulk of his return has come in the form of dividends. So the track record is building, and it's looking quite solid at this stage. Just in terms of our concerns as a business, our responsibility, our fiduciary responsibility to clients is to interrogate all these products. And we do have some concerns. One concern is the marketing pitch. It's focused on that 100% tax deduction up front. So if you look in the newspapers and, on the internet, that tends to be the focus of the marketing pitch around 12J. But yeah, as we mentioned earlier, there are some fairly clear criteria set out in section 12J, and breaching those criteria results in penalties potentially, which could affect the client's values. As I said, it's not a product for cost-sensitive clients. Just the way these investments are managed, it is a bit more expensive than a fund manager who benefits from scale sitting at his desk and can look at 100 shares listed on the JSE. This is a more kind of intensive process as an alternative investment. And then I think what we do see is that there tends to be aggressive use of the tax deduction in calculating client returns. So I think clients just need to be aware of that. Because when they look at their statements, what happens is clients' expectations get set at one level, and that they don't kind of connect the tax deduction in the calculation of that expected return. So when they see a statement and they're getting 8%, they're upset because they were expecting maybe 15%. But when you factor in the tax deduction, the 15% comes in. So it's just one of those unintended consequences that clients need to be aware of. And there we see that depending on your tax rate, for the same underlying investment, your return experience can be quite good. Okay. And then I think we've discussed this point that, yes, it's a 5-year investment, but be prepared to be invested for a lot longer than 5 years. I'm just going to skip through this part because there was an opportunity on a structured product earlier, but that opportunity is gone. Mm-hmm. And I'll take you through a worked example on looking at the impact of tax on various products. So we just made an assumption of a 350,000 investment, marginal tax rate at 45%. The 350,000 number comes from that being the maximum that you could put into a retirement fund and qualify for a deduction. Mm-hmm. We assume that interest exemptions and deductions were used up. A modest 8% per annum return with a 50% allocation to equities and fixed interest. Just to kind of look at the impact of tax on return. And what you'll see is that your retirement annuity and your 12J, because of the tax deduction that you get up front and what that means for your investment is that your effective investment amount is a lot lower than what you invest as a client. That from an 8% return in an RA, you could land up with a 21.7% return by getting 8% per annum on the 350, which is in your RA. The 12J has to pay capital gains tax on the full proceeds. So that's the key difference between those two. And then when the client retires, there's retirement funds tax that will apply. And then, we looked at some other accounts. The tax-free savings account, this is not a negative return. Just because of the example that we had to use, that would actually not be a deduction. It would be a penalty of 126,000 because any investment over and above the minimum is taxed at %. So that's why you're looking at a negative number in this case. But ordinarily, clients would not invest more than the 36,000 Rand allowance. And there we have unit trusts and endowments on the right-hand side. So clear kind of winner emerging in the form of retirement annuity, with Section 12J not too far behind. However, I think it's important that clients remember that when it comes to investing, it's not only about tax. So they've got to understand their liquidity requirements, how much flexibility they need in their investment, the extent to which they need to be able to have some kind of control, income, if there's an income requirement, and then divisibility in terms of, if they've got R1 million investment and they need to take 50,000 Rand out, can they do that? Obviously, if you've got R1 million property, you can't sell off the garage and get 50,000. You've got to sell off the entire property. So that's also an issue. And then the issue of tax efficiency. So what you'll find is that the tax efficient investments generally have other kind of areas where they tend to fall short. And so clients just need to remember that in chasing tax efficiency, they're not compromising on another critical aspect that needs to be considered for their investment. And I think, that was the full extent of the presentation, really giving clients a context for making a decision around investing in 12J and tax efficient investments in general.
Craig, that is such an impressive presentation. I've heard it more than once now, and every time, you just open my mind to the options and how things really need to be balanced. Obviously RA is the winner in your scenario, but obviously I think for many potential investors in RAs, that there's concern over prescribed assets. Whether that will happen or not, no one knows. And as a consequence of that potential, I have seen investors lean towards 12J because of the tax benefit and knowing where your money is going to land. But if you have the liquidity, obviously 12J is capped at 2.5 million Rand. An RA would make sense. And I think, you've also raised a couple of issues in the Section 12J market, which, I have brought up on a number of occasions, particularly the costs. I think 12J fees, particularly performance fees, can be very high. Investors need to know that they're in for 5 to 7 years. It is an illiquid investment. And a huge misunderstanding for many investors, and you touched on the point a few times, is the tax benefit alone gives investors approximately 8.3% if they're in the highest marginal tax rate. So just by investing in 12J, if you get your money back with no growth and you receive your refund, you're getting an 8% return. And when investors see the targeted returns or the actual returns of a 12J, they don't deduct the 8%. And by deducting the 8%, then you really start to understand how the underlying portfolio is doing. So it's vital. But I think you've touched on a number of points which has really sparked a lot of questions in my mind. And I think a lot of the viewers who are going to read this are going to have many questions for you. So this will definitely not be the last interview, I hope, if you're available. But you've really touched on some points which I think will leave a lot left unsaid and a lot of questions to be asked. Thank you. Thank you very much for your time and your insight. And there's a lot of information here for us to think through.
Yeah, you're welcome, Jonty. People are welcome to get hold of me, but also happy to take questions that come via yourself. And as I said, it's a fairly young product, so it's not completely intuitive to investors at the moment. There's quite a bit that they need to get to understand. But I think certainly these kind of initiatives help in that process.
Definitely. Craig, thank you very much for your time.
Great. Thanks, Jonty. Take care.
You too. Bye.